Asia Poly Holdings Berhad or APH was established on 20 June 2003 and listed on the AIS market of Bursa Malaysia in 2005. The company operates as an investment holding company with its core business in acrylic manufacturing. Its main products are ACASE, acrylic sheet, and acrylic block, which are used in industry such as construction, automotive, healthcare, and signet. Besides acrylic manufacturing, the company has diversified into renewable energy and property development. In 2025, APH recorded revenue of RM 88.99 million due to its strong market presence, diversified operation, and long business history. The company is currently in the maturating stage of the business life.
Good day. Today, I'm presenting our strategic framework for AP Group Ventures and RM50 million growth fund. To protect our institutional and private capital, we are avoiding upfront deployment. Instead, we have structured a four-tranche system releasing capital only as core legal, revenue, export, and green energy milestones are explicitly achieved. Our deep dive due diligence focus on Asia Poly Holdings Berhad, while post-pandemic raw material inflation historically dragged down margins. FY 2025 demonstrated a stellar operational turnaround. Gross margin surged to 16.03% and net profits returned to positive ground. This is backed by a highly viable dual-engine business model, a strong globally exported cast acrylic brand paired with a recurring revenue pipeline from new biogas and hydro energy infrastructure. We have mapped out 4 principal risks, including input cost volatility and foreign exchange exposure. However, because capital deployment is strictly tied to performance gating and because the company possesses excellent structural diversification, we conclude that Asia Poly stands as a highly viable, risk-mitigated addition to our venture capital portfolio.
For investment decision, based on our rigorous due diligence, AP Group Ventures has issued a definitive proceed directive for Asia Poly Holdings Berhad. We propose a strategic investment of RM15 million for a 12.5% equity stake and active board seat. This limits our exposure to 30% of our total fund, preserving excellent diversification to protect our capital. This will not be a lump sum payout. Funds will be released progressively tied tightly to operational milestone. Why Asia Poly? Because they offer an exceptional recession-proof dual-engine model. They pair their high-growth global ACAS manufacturing brand with high margin, recurring revenue from renewable energy assets. This perfectly positions us to ride massive regional demand and ESG tailwinds with maximum downside protection. Let's capture this opportunity.
Next, I will present the IPO performance of Asia Poly Holding Berhad. Asia Poly was listed on the Muscat market, now known as the AIS market, on 26 October 2005. During its IPO, the company issued 22.179 million shares at an issue price of 34 cents ringgit per share and successfully raised approximately 7.54 million ringgit. The fundraise helped support the company's business expansion and long-term growth plans. To evaluate whether the IPO was successful, we can look at the company post-IPO performance. One major achievement was the increase in production capacity from 200 metric tons per month to 1,400 metric tons per month. This represents 600% growth in capacity. In addition, about 68% of the company's products are exported to overseas market, showing strong international market presence. The company has also diversified into renewable energy and property development, creating additional growth opportunities. In conclusion, Asia Poli's IPO can be considered successful as it provided capital for expansion, increased operational capacity, and exported the company's long-term development. So that's all for me. Thank you.
So for this session, I will be presenting the financial distress and turnaround analysis of Asia Poli Holdings Berhad. The objective of this analysis is to evaluate the company's financial health from 2021 until 2025 through the three key areas such as profitability, liquidity, and solvency. Based on the findings, we will determine whether the company experienced financial distress and identify the potential future risks together with the appropriate preventive strategies. So, this financial health analysis focus on three important dimensions. First of all, profitability. Measure the company's ability to generate profit from business operation. Second one is liquidity, which evaluates the company can meet the short-term obligations. And third one is solvency, which assess the company long-term financial stability and debt management capability. Together, these ratios provide a comprehensive overview of the company's financial condition. Gross profit margin measures how efficiently the company converts sales revenue into gross profit after deducting the production costs. So, based on the 5-year trend, Asia Poli gross profit margin declined from 5.65% in 2021 to 2.60% in 2023. This decline was mainly caused by the rising prices of the MMA, the company's primary raw materials. So, however, a significant recovery was observed in 2025 when gross profit margin increased sharply into 16.03%. So, this improvement suggests a better cost control, improve the production efficiency, reduce waste, and stronger focus on the higher margin products. So from an investor's perspective, this is one of the strongest indicators that the company's operations are becoming more efficient. Net profit margin measures the company's final profitability after all operating expenses, finance costs, and taxes have been deducted. So the company recorded like negative net margins from 2021 until 2024, indicating the continuous losses during this period. So these losses were influenced by the rising production costs, higher finance expenses, and weaker profitability performance. So in 2025 marked an important turnaround as the company recorded a positive net profit margin of 0.46%. Although the margin remains relatively low, but it represents the first return to profitability after 4 consecutive years of losses. Return on equity, or we call it as ROE, measures how effectively the company generates returns for the shareholders. So between 2021 until 2024, ROE remained negative due to recurring losses and declining profitability. So this indicates that shareholders were not receiving positive returns on their investment during the period. So in 2025, ROE improved to a positive, such as 0.33%, while still below the industry expectation, but this result signals the beginning of the financial recovery and improve the value creation for the shareholders. So the next one is current ratio. So the current ratio evaluates the company's ability to meet short-term liabilities using the current assets. So Asia Poli maintained the current ratios above 1.0 times throughout the 5-year period, although the ratio gradually declined from 2.2 2.29 times in 2021 to 1.48 times in 2024. It improved slightly like 1.59 times in 2025. This indicates that the company continued to maintain sufficient current assets to meet the short-term obligations, suggesting that an adequate liquidity position despite the operational challenges. The next one is the quick ratio. So the quick ratio provides a strict measure of the liquidity because it excludes the inventories from the current assets. So unlike the current ratio, the quick ratio remain below 1.0 times from 2022 onwards. This suggests that the company relied heavily on the inventory holding to support its liquidity position. Although the ratio is improved slightly in 2025, it remained below the ideal level. So therefore, the liquidity management and working capital efficiency remain important areas for the improvement. The next one is debt to equity ratio. So the debt to equity ratio measures the level of the financial leverage by comparing total liabilities against the shareholders' equity. So the ratio increased from 0.41 times in 2021 to 0.69 times in 2024 before improving to 0.62 times in 2025. So this trend suggests that the company relied more on the external financing during its weaker financial years. However, because the ratio remained below 1.0 times throughout the review period, the company's leverage level is still considered manageable from a financial perspective. The interest coverage ratio measures the company's ability to pay finance costs using operating earnings or EBIT. So between 2021 until 2024, the ratio remained negative because the company recorded negative operating earnings. This means that the operating profits were insufficient to cover finance costs during those years. A significant improvement was observed in 2025 when the ratio turned positive at 1.2 times. This indicates that the operating earnings finally exceeded finance costs, representing an important milestone in the company's financial recovery. Based on the overall financial analysis, several ASEAPOLI Holdings Berhad experienced moderate financial distress between 2021 until MLA raw material prices. This assessment may increase production costs and reduce margins. Negative return on equity, weaker global market coverage ratios, and liquidity pressure reflected in the quick ratio. However, the company was not facing competition with the acrylic manufacturing industry, which may create price pressure. So the final ratio remains above 1.0 requirements and increase debt to equity ratio remain below 1.0 requirements throughout the review period. So most importantly, despite the positive recovery, clear signs of the recovery through positive profitability, the first risk is volatility in MMA. To mitigate these risks, several preventive strategies are recommended. So the first one, the company should diversify its raw material suppliers and to reduce dependence on a limited number of the suppliers. Number two, management should continue expanding export markets and strengthening the customer relationships. Third, number three, the company should focus on the higher margin products while continuously improving the operational efficiency and cost management. Finally, ASEAPOLI should strengthen the ESG initiatives and sustainable manufacturing practices to improve the long-term competitiveness. So in conclusion, ASEAPOLI Holdings Berhad have experienced the moderate financial distress between 2021 and 2024. However, the strong improvement recorded in 2025 indicates that the company has entered an early recovery phase. So if management continues to maintain the financial discipline and operational efficiency, the company has the potential to achieve the stronger financial performance and sustainable sustainable growth in the future. So thank you.
Hello, my name is Charlie. Now we're moving on to the conclusion. Our overall analysis shows that the Asia Poly Holding Berhad is currently in the early stage of financial recovery after experiencing several years of losses. The company has shown positive improvements in its financial performance, especially with a significant increase in gross profit margin and a stable capital structure. In addition, its diversification into renewable energy and property development provides new opportunities for long-term growth and reduce its dependence on the acrylic manufacturing business. However, there are still some challenges. For example, profitability remains relatively low. The company still relies on inventory to support liquidity, and its performance is exposed to fluctuation in raw material prices and foreign exchange rates. Therefore, based on our overall assessment, we recommend a hold investment decision. This means the company is suitable for long-term investors with moderate risk tolerance, while waiting for stronger and more sustainable financial performance in the future. Looking ahead, the future outlook for Asia Poly Holdings Berhad is generally positive. The growing demand for acrylic products, together with investment in renewable energy projects and business park development, is expected to create new income sources and support the company's long-term growth. Nevertheless, investors should also be aware of several risks, including raw material price volatility, foreign exchange fluctuations, increasing competition, and potential economic slowdowns that may affect market demand. To strengthen its competitive position, the company should continue improving operational efficiency, develop higher value-added products, optimize inventory management, and expand its sustainable energy business. So in conclusion, Asia Poly Holding Berhad has promising a long-term growth potential. However, investors should continue to monitor its profitability and cash flow performance before expecting significant shareholder returns. That's all from us. Thank you.